come the first rates then, and let's see what the Nifty has started off at. Absolutely flat at that 19,443 odd level for the Nifty. Want to see what the Nifty IT index is up to and then what the Nifty Bank is doing, because that's where you're seeing pretty contrasting moves. IT was a winner yesterday. Banks were the ones which were struggling, although they too recovered from the session lows quite a fair bit. But today morning, you're not really seeing much of a move for the Nifty IT index. In fact, since we're on the subject of Nifty IT, let's just revisit some of the big movers from yesterday. And Oracle Finance, for instance, amidst the mid-cap names, held out. Infosys, of course, after that deal from LG, that saw a move of nearly about 2%. But today, it's a lot more simmered across the screen. NTPC, though, I can spot. That's the one which is actually holding out. Bernstein has initiated an outperform with a target price of 274 on NTPC. That stock holding up 1% higher as we speak right now. They say that valuations are below the long-term averages, and that NTPC plays a key role in transition to green energy, which is underappreciated as of now. M&M Finance, let's see what that also is up to. Morgan Stanley has come out with a note after their earnings were a miss. Downside risks to loan yields continue according to them, and upside risks to cost of funds also persist, though M&M Finance starts off absolutely flat in trade right now. The big buzzers then from yesterday, let's revisit some of those. That would be important. So let's try and see, what is the move on a BEL, on a HAL, what the likes of these shipbuilding names are up to, considering the big move that you saw on most of these names in trade yesterday. Remember, Germany and Spain are in now contest of almost a $4.8 billion Indian submarine deal. The likes of a Mascot, GRSC, Cochin Shipyard, all of them were buzzers, and they continue to hold out very, very smartly in trade this morning as well. Adani Ports, I can see, is seeing some amount of green at least on the screen. I also want to revisit what the likes of a Power Grid are up to. They've commissioned assets, in the northeastern part of the country, strengthening their scheme for the VI project. So that's one stock which is in focus. RVNL JSPL, the cabinet, remember, has approved the 7 multi-tracking projects worth about 32,500 crore rupees. So that's another stock also which is going to be in focus this morning. But Kunal, yes, it's an absolutely flat start. So what trades are you punching in?
Yeah, flat start so far. The only shining light so far is that the Bank Nifty started to open with a slight positive tinge, and the premium for the Bank Nifty is increased up higher from 120 to 160 points. Now, in terms of opening trade, Titan is something which I would look to go for a shorting opportunity, because I sense that the stock has come back towards a mild bounce before it tries to retest the previous lows of 2,900.
Naresh, what about your first trades?
So like a Power Grid as a defensive bet looks like 247, 248 with a stop loss at 245. I expect a move towards 260, 270 in the short term.
All right, there you have it. Those are the first trades from our charters. But let's move right on then and focus in on what the outlook is for the markets. So we've got Nikunj in conversation with Nilesh Shah, MD and CEO at Envision Capital. Over to you, Nikunj.
Gives me great pleasure always to bring on board Nilesh Shah of Envision to talk about markets, stock picking, the idea of value in this kind of a market, and where is margin of safety in this market where everybody suddenly is now excited, curious, and are ready to commit to capital. We've had a good rally in 2023. We're calling it the summer rally of 2023. Will this rally extend into the second half? If yes, what are the factors which are at play? Nilesh, always a pleasure to interact with you. Thank you for joining us. We haven't done this show in a while, actually. This is one show with you especially. I always look forward to learning and understanding.
Absolutely, Nikunj. Always a pleasure to be here in your studio with you on ET Now. It's always a pleasure.
Thank you very much. So Nilesh, let's understand the market setup. Now I can look at the market on a YTD basis and say, okay, nothing, 5-6% here or there. But if I look at the market from the April low, it's more than satisfactory for index, more than satisfactory for individual stocks, and great when it comes to small cap stocks. What is the right prism to look at the market?
No, I think that's a great way to put things in perspective. And I think what has really happened, Nikunj, are two things. One is on the earnings side, by and large, most companies have positively surprised. Let's look at the backdrop. CY22, it was all about cost pressures, inflation, will the consumers buy enough, will the producers be able to pass on the elevated costs. And you come into 23 and just look at the kind of earnings which most companies have reported, the kind of margin improvement which most companies have reported, and the kind of economic growth that we have been able to sustain as an economy. So I think that's really the starting point where I think the earnings have been ahead of expectations, especially for smaller companies. People thought with the pressures of 22, small companies will get crushed. But that honestly didn't happen. We've seen that with a lot of our portfolio companies where actually the small guys are growing better and are turning even more capital efficient. The second thing is liquidity. I think the time retail investors or domestic investors sense that interest rates have peaked and that at best what you could get in bank fixed deposits is the 6-7% on a pre-tax basis, I think they clearly sense that it's time to kind of be back into the SIPs, back into mutual funds or buying stocks directly. So I think it's a combination of both these factors which I think has surprised all, and that has resulted into the markets having a pretty strong run from the lows of March or April.
Okay. We'll put out the graphic of the market from April, and this market first managed to climb the wall of worry. Then came the earnings push, then came the liquidity trigger, and now the reverse trend has started, which is QIPs have started, block deals have started, IPOs have started. So typically when markets, they see influx of IPOs, block deals, promoters selling out, it has always coincided with a near-term peak or a pause. So while the long-term picture nobody is arguing, in the near term, do you think this market now could be hitting into a pause or a range-bound phase?
Quite possible. After this kind of a rise that we have seen, it's pretty much, I think, relatively or reasonably obvious to assume that we could hit a wall soon, given the kind of run-up that we've had. And I think that would, as we all say, that would probably be a healthy correction, a nice shakeout. I think in addition to the kind of rally that we have seen and the kind of up move and the uptick that we have seen in terms of valuations, there are three other headwinds which are emerging. One is crude oil is also kind of up quite significantly from the lows that we saw in the earlier part of the year, and we know that crude has remained our biggest challenge for now, years or for decades. And when crude goes up, that does have an impact on earnings, it does have an impact on growth, and it does have an impact in terms of the stock prices. So I think crude is one big challenge. The two is basically, will that lead to a further spike in cost of commodities? And again, therefore, does that bring back to the table the possibility of margin pressures again? Because we've had great margins for the last 1 or 2 quarters. So that, and third is cost of capital. I mean, again, the US Fed probably, I think what I read is that they're saying is that probably they're not done with. And if there are further rate increases, our own Reserve Bank of India has increased the CRR. I think that's an indication that maybe a rate cut is not round the corner soon. So I think these are the three, I would say, headwinds or challenges which could also lead to we hitting the wall much sooner. In addition to, of course, supply of paper, supply of securities coming in from all these QIPs and all of that. So I think on the whole, we probably for now, at least in terms of the very short term or the very near term, I think there's a high chance we can get into a pause mode.
Today we are not talking about it, but a year from now or maybe 10 months from now, everybody will talk about it. The importance of central election, which would be preceded by 2 state elections. Nobody's talking politics, but that will occupy center stage. As a portfolio manager, what will you do? It could be a binary event. So how do you do risk management in the run-up to the election?
Nikunj, honestly, that's a very tough one. And I have seen many of these elections play out, and in several of the cases, the election outcome has been pretty opposite to what we could have imagined. I mean, I go back to 2004 and similarly 2009. These were really honestly
circuit down, circuit up.
Circuit down, circuit up. So one has seen all this, and honestly, as long-term investor or as a portfolio manager, it's very, very difficult to honestly try and anticipate or second guess how the elections will go.
So for our viewers who are watching this, Nilesh, this question keeps on popping up now. Would you advise that stay the course? I mean, if you're a genuine long-term guy, don't worry about the near-term politics. If you are in for long haul, 3+, 5+, just stay calm. Don't waste too much of your energy in analyzing your portfolio impact in the election cycle. Is that your message?
Oh, absolutely. I think one should stay calm, stay composed, and stay disciplined. Clearly, very clearly, have your allocation strategy. Keep identifying great businesses or great managers with whom you would want to invest. And I just think stay the course. I think India is up for some really great times. I genuinely believe that our time has come. This is going to be India's decade. And there is going to be huge amount of growth opportunities. And so I think that those who have missed the party so far, I still don't think it is too late. I think be there, have a plan, and remain disciplined.
Okay. We'll talk about a sector which you track, IT. And what we've done is that since you were coming, my producer anticipated this question. And she's brilliantly looked at the 5-year averages for large cap IT stocks, just for our reference for our viewers. So Nilesh, I'll split the IT space right in the center. Bread and butter business and the AI challenge. The bread and butter business is a function of US economy. AI is something which no one knows. Analyze the big picture for us. Post-COVID, the sugar rush is over, but AI disruption is real. What is the best way of looking at IT now?
So Nikunj, the way I look at IT, and I'll probably slightly cast a more long-term perspective. I think the big boys in IT, I think they are great capital efficient companies, but they're going to be relatively moderate in terms of their growth rates.
Okay.
No matter how great the opportunity
The size has become large for them.
Their size has become so big that I think it's going to be hard for them to kind of grow in double digits. Even if you look at, say, an Infosys or a TCS, the last 10 years, and in last 10 years, so much of technological advancement has happened. They have grown at probably 10, at best maybe 12% in terms of the revenues and maybe 13-14% in terms of earnings. Now that's not bad. It's good, but they're not necessarily those hyper growth stocks. They're brilliant in terms of capital efficiency. They will sustain a 25% margin. They'll have 25% ROE. So that's great. So it's always great to buy them around towards the lower end of the valuation range.
Are we there yet?
I think we were there in early April when, say, a stock like Infosys went to about 21 times trailing earnings. I probably think that close to 20, 21 times is a very good floor for a stock like this or a company like this. I think you're better off just, following this principle that these are essentially, they have demonstrated the power of scale.
Yeah.
Okay. But beyond a point, scale doesn't deliver growth because the scale itself becomes your own enemy or your own challenge. And I think that's where really the big boys are in. Obviously, if you're running an index strategy, a large cap strategy, it's a good place to be. Then we went on to the power of specialization. There were a lot of companies, like say a Tata LXC,
which did very well.
Which did very well.
What
the power of
20x?
You know what, Nikunj? It's actually over 10 years been 100x.
Yeah. Wow.
If you were having this discussion in 2013 and you had two options, and why I'm bringing this up is because today NVIDIA is so much celebrated.
Yes.
In 2013, if you had put your money in, and you didn't know what NVIDIA was,
yes.
at least let me be honest, I didn't know what NVIDIA was, but I knew what Tata LXC was. Outcome in 10 years has almost been the same.
Wow.
From the bottom to the peak. And this I'm saying is when Tata LXC was at 10,000 rupees, 1.5 years back. Maybe
and Tata LXC was never the top top recall name for anybody.
Absolutely.
2000 to 2015, it never did anything great.
Yes.
It was a Tata Group company, but always disappointed.
Yes. But it ended up, so if you look at it, Tata LXC sometime in 2013 was actually at 100 rupees. And sometime in late 21 and 22, it went to 10,000 rupees.
What price did you look at?
We'll not get into that. I'll stay away from that. But I'm just trying to consider, but that was the power of specialization.
Yeah. Okay, fair point. It's a great point.
I think from there, we've moved on into the world of the power of products.
Okay.
Where a lot of the SaaS-oriented companies or companies which were very focused on specialized areas You could be a SaaS provider in the travel hospitality vertical, or you could be a SaaS or a products company in banking, financial services. I think it's important to look at that part. It's great to look at, I think, some of the platform companies who are using technology to grow, or look for companies which are deep tech companies.
What is deep tech?
I think where you have developed so many strong competencies which are very hard for anybody else to create and have a very wide ranging applications.
Which company qualifies the cut?
So currently one company that we've just recently invested in, we own it, is essentially MapMyIndia C Info Systems, which went public I think a year and a half back.
But they've had a volatile delivery record.
Not really, and that's always a challenge, that a service company can deliver to you quarter on quarter performance.
Yes.
But a product company may not be able to deliver you quarter on quarter performance.
We're not used to tracking it that way, so markets they tend to get nervous.
Correct. So you have to, I think we all have to come to reality that IT services is one thing and products, SaaS and deep tech is another thing.
But globally, Nilesh, SaaS companies have also come down. A clear example is Farmworks, Freshworks, I beg your pardon, thank you.
Yeah.
It had a great listing. SaaS, the first Indian SaaS company to go public, and then it's down, it's struggling, it is not reporting great numbers.
Yes.
So while SaaS is a great idea, but theoretically, globally, SaaS companies are not doing well. And I've seen globally what happens normally adopts here.
The challenge with those companies is that they still don't make money.
Yeah.
They still have losses. Some of them have accounting losses because of high ESOP provisioning, but otherwise they don't have clear demonstrable earnings to showcase. And public markets are always about earnings and cash flows. No matter what you grow, but earnings and cash flows matter the most. Fortunately, in India, we have some of the companies in this bucket which have relatively more consistent growth. They may not have the hyper growth, but they still have growth and also have strong earnings and cash flows. And I think, I also believe that this is not just India's decade, it's India's decade. And therefore, any company which has deep tech capabilities and has a wide ranging use cases in the Indian context, I think can be in for good times.
Any new acronyms?
Well,
you always give us one.
No, none for now. But I think so. So again, coming back to technology, I still think that there are several opportunities in the broader market. I think if you take your eyes off the top 3, 4, 5 names and look at maybe some of the other companies, I think there are interesting opportunities.
What is your basket of tech looking like then? MapMyIndia is one. I think you had LTT.
LTTS is something which we continue to own. NewGen is something that we have liked, and I think it's a very interesting company also. So I think for now, I think we have these 3, 4 such kind of companies which we believe have a very good runway of growth. But I think we keep scouting out for opportunities there.
Nilesh, we talk about banking, and the sector has just delivered parabolic earnings growth. Stocks did very well in 2022. They did reasonably well in 2023. But is banking more like a consensus trade? Everybody likes it, everybody owns it, and that's when the underperformance will start. And this year the Bank Nifty did nothing, frankly, if you think about it.
So again, I probably think, Nikunj, that even in banking we could go something similar to the way we've seen in IT.
Okay, so let's do that.
That the top 3, 4, like the top 3, 4 IT companies, I think similarly the top 3, 4 banking companies will probably grow in double digits.
Okay.
So obviously that growth rate is better versus the top IT companies, but I still think probably they'll grow at about maybe 15% plus minus 2-3%. I think versus that we will see a lot of smaller banks or specialized lenders. Or maybe some of the fintechs itself who can grow at a much higher pace, who could potentially grow at twice the rate of any large bank. And I think therefore still there, I think one should look out for some of the emerging names out there. Some of them have IPO'd themselves recently, some of them have IPO'd over the last 2-3 years. But that's again a very interesting space.
But Nilesh, in banking versus IT, it's always said that size matters and the right to win, the CASA, the brand recall, cost of liability is always with the large guys. You look at the cost of liability of SBI and I compare that with a Chotu PSU bank. Similarly, HDFC Bank service, network, market domination versus a small bank. While the rate of change could be different, here we are talking about customer experience, ability to withstand the shock, bet on size and market share gains. They still are moving towards large cap banks.
No, that point very well taken. But what we have seen essentially is that one is, of course, apart from all of this, what you mentioned, I think the credit cost is, I think, very important. Your ability to, price your loans well, price your risk well. I mean, to know risk well, price it well, and monitor it well, I think is the defining feature of any banking business or any lending business. I think any bank who gets that right, irrespective of the size, will be a winner.
So cost of liability is important.
Credit cost, I think, to me is the most important thing, followed by cost of liabilities. And what's happening, Nikunj, I think, is unlike the past, maybe 10, 20 years back, you probably had faith only in the top 2-3 names.
Yeah.
But I think thanks to an extremely good regulatory environment, the fact that we have such proactive regulators, I think they have been able to create a lot of trust and faith in the system. Look at what's happening to banks in the US versus the banks here in India. Okay, huge difference. And I think a lot of credit for that goes to our regulators who have been able to create that faith in our financial system and in our banking system.
What happened with some of the banks was an asset liability mismatch. Unheard of, that situation unheard of, at least in India.
So I think a lot of the smaller players in India have been able to either create a very good liability franchise or have been able to raise a lot of capital from private equity funds and therefore today have enough cushion to grow at least for the next 2, 3, 4 years. So I don't know what will happen maybe 5 years later or 10 years later, but at least for the next 2, 3 years, a lot of the smaller and specialized players in the banking and lending and credit space will probably do much better than the very large and the very obvious names.
You've been a happy investor in IDFC Bank. I think you bought IDFC Limited and IDFC Bank both, and now the merger goes through. The stock has gone almost 3x in last 1.5 years. Are you, as of today, do you see that becoming one of your core, will it stay one of your core holdings for next 2-3 years?
It looks like, Nikunj. I think they've done a fabulous job on execution. Look at the kind of challenges which they faced. As they say, that it's an existential crisis. And I think at least so far they have been able to convert that adversity into an opportunity where they, in this period, they essentially wrote off all the legacy loans. They built a very solid liability franchise of maybe 45 to 50% CASA.
Low NPAs.
Managed credit costs very well, especially on the retail book. Obviously, of course, the naysayers will keep saying, let the book season, we will have to see what the credit cost is and all of that. But you have to keep in mind, they have been doing this for 15 years and not the last 5 years in their earlier avatar as Capital First. So I think on the whole, it looks fantastic. I think if they continue to do what they do currently, I think they have a great chance of being an outstanding bank. The big lever which they have is the cost to income ratio. If you look at any of the big banks, the cost to income ratio is at 40 to 45%. For IDFC First Bank, it's at 70 to 75%. That's because they've been investing in branches, people, talent, technology.
Legacy also was a challenge for
all
them,
of that. If over the next 5 to 10 years, if they can basically bring down that 70, 75% to 40, 45% and keep growing the loan book at maybe just about 20%, that can translate into some really nice compounding earnings growth for a long period of time. And so I think they have a fantastic opportunity ahead of them. They have great levers out there. Let's hope for the best.
It's been a new learning for me, Nilesh, so I'm sharing with our viewers that if you look at the Indian market setup, 90% of the participants have a view which is less than 1 year. 5% of the market participants have a time frame of 1 to 3 years. And less than 2% market participants have a time frame of have more than 5 years. So I'll take the first one out because this is where you don't invest. 1, 2, 3 is where you look at turnaround stories, market share gain, inflection points. And 5-year plus is where you look at classic compounders. So let's understand in time bracket. 1, 2, 3, what qualifies the cut for you? 5 plus, what qualifies the cut for you?
I think in 1, 2, 3, it would be businesses like the CAPEX kind of companies because we are at the start of an investment cycle. So a lot of these product companies will do extremely well. People who essentially are supplying equipment and components and consumables to a lot of the infra projects or to some of the manufacturing companies. I think that space will do extremely well for the next 1 to 3 years. I think there's a good chance for real estate and real estate oriented companies to essentially keep doing well. I think from a more longer term perspective, I think pockets again like specialized technology, specialized banks or specialized lenders, some of the fintech kind of businesses, discretionary consumption, especially those where a very young growing middle class is beginning to tilt its consumption basket towards. So companies which are into alcoholic beverages or consumption or some of the other luxury products, if you would call them as luxury products, I think that kind of a basket looks pretty good from a 5-year plus kind of a horizon, because these are huge markets, underserved markets. And I think if you can find a company which essentially is at the forefront and is in a vantage position to ride this long runway of growth, I think you could essentially be sitting on some great compounders.
What we'll do now, Nilesh, is that we'll look at few multi-baggers, and these are absolute standards. You know, the first multi-bagger, if you talk about last decade, is Bajaj Finance. That's the top recall. Last 20 years is HDFC Bank. Tata Elxsi, another multi-bagger. But there are some very ordinary names in last 10 years which are up 20 times, 25 times. One is Tube Investments. Never thought that a classic like Tube Investments could be a multi-bagger in last 10 years. Other one is Escorts. Out of the blue, Rakesh Junwala invested in it and just hit out of the park. The third one is Sundaram Finance, Sundaram Fasteners. These are old companies, Nilesh, but suddenly they've changed their gyration and their trajectory in last 10 years. Which are some stocks which may not be part of new tech, fintech, not part of the new breed of IPO, but these are companies which are at an inflection point because they've done the hard work, they've done the groundwork. So they are in the existing pool, old vintage crop, but the new season has started for them. From the vintage, from the classics.
No, I totally agree, Nikunj. And at times, you know, we keep saying simple is boring or old is boring, but...
Which is so fascinating when I looked at Tube Investments, Escorts.
Absolutely.
Even Raymond's.
Yes, absolutely.
Whatever may be the reason, it's got done 132 to 2000 in 10 years.
Yes. My view is it would probably somebody from the manufacturing pack. I think the manufacturing pack is up for good times. A lot of reforms have happened in the last 5 to 7 years which benefit manufacturing companies. I think a lot more will be done in terms of reforms. So I think manufacturing is one great place where, you know, a lot could happen. And I think in the overall, while of course electronic manufacturing services, the EMS players and all of them are there, but the valuation, the businesses could still compound at 20, 30, 40%, but valuations are of course
what would you be looking at buying if there is a panic in the market? Look,
I think I'll sorry?
I mean, if there's panic in the market.
No, I think if it is manufacturing and if it is in that context, I think it would be a great auto component company. I think something in auto components, I think would probably pass the muster.
Okay, whole host of stocks and market ideas coming in from none other than Nilesh Shah from Envision Capital. Let's move on. Let's just take stock of where the market has settled in at. It was a very, very quiet start for the benchmarks, and it continues to be so. We've drifted a little bit lower, but down about 0.3%, about 50 odd point is the dip that we're currently seeing. Sectorally, it's textiles, realty, financials, bankings, which are taking the lead. Cement, oil and gas and power are the ones which are the laggard sectors today. But still digesting a lot of earnings, so let's address one such set. We have with us the management of Endurance Technologies joining in on the show, Ramesh Kehani, the ED and COO. Ramesh, hi, morning. Good to have you today on the show on ET Now. You know, I'm just going through your numbers. You've seen a good jump on the margins on a year-on-year basis, but it's still far from what the company used to enjoy, you know, that 14 to 18% in the past. What's the outlook on margin growth, and when is it that we can hope to get back to that range?
Well, good morning. First of all, to answer your question that we are still not at the original place of our margins where we used to be. The market is also not over there as it used to be. You know, the industry is down. And just about 2.7% this year is their growth rate, whereas we have grown around 16%. Now, looking at the challenges that we encounter or the industry faces or the auto component faces, right? I think we are in a pretty good shape as far as margin is concerned because we are improving. from 11.1%, we've gone to 13.1, and on a consolidated basis, it's 13.7, because some of the factors are softening down in Europe, where electricity prices are coming down. So I see no reason why we'll not be there, in the next couple of quarters, as soon as we, find these variable costs which are hitting us right now to soften out. So I see that there are other rooms also where we can improve on our margins, like premiumization and others, which the actions of which are very strong at our place.
Sure. Since you talked about the industry itself not being at the levels as it used to be in the past, what is that you're expecting in terms of, the domestic two-wheeler demand this year?
See, it's a difficult, projection to give, because the challenges are still quite a bit. And with the EV sectors, getting high traction, although it's down a bit right now. But, there's a change in configuration of the vehicles also which is happening. Premium bikes are going up. Everybody's eyeing a higher segment of bikes. So there are some challenges as far as the target audience is concerned. But if I look into what we had the best was somewhere around 24.42 million vehicles in FY19, whereas currently we close somewhere around 20 million odd. So 4.2 million, still there's a headroom for extra volumes to come in, and there's a headroom for the new configured bikes or the premium bikes to come in and take a better space.
All right, morning. I wanted to also understand the outlook in terms of order wins, because it has been strong from the premium two-wheeler segment, the likes of Harley and Triumph, which have received a great response. So what's your outlook on the further orders or reorders?
See, I'll tell you one thing, that we have won some around 300 crores of business, new order wins in this first quarter itself. Last year, we acquired 935 crores of business, which is a good going, looking into the market conditions, out of which 78% is new business wins, so which is very good, in the sense that replacement business is one part of it, new business is one part of it. For example, in disc brakes and we've acquired more businesses from customers. We've added up EV segment into our portfolio to a large extent. And that's close to 600 crores in the past, so far 600 crores. And, all these orders are going to play a big role in our revenues in years to come.
Okay, fair enough. And how's your overseas business shaping up? Do you think that, we can see the overseas business picking up momentum? And how is the domestic business shaping up in comparison?
Well, domestic business has always been better than the overseas business as far as the numbers are concerned and volumes are concerned, because these are two different continents which are having different product segments and all. Over in Europe, we are into four-wheeler segment, and that too die casting and machining. Over domestic, we've got plenty more to do in proprietary business, transmission, brake, and suspension. So the two business models are a bit different. But I think Europe is doing pretty well. As keeping in view that the challenges that they face with are much more than us. And some respite has come by the electricity costs coming down, and volumes of EV business which we've acquired are pretty strong, and I see no reason why we should not be moving much better than the industry out there.
What about EVs? Because that comprises about 42% of the order book. How is it that you're seeing it growing, and what are the plans to really add more clients?
See, acquiring new clients has never been, a story that ends with Endurance. We keep on acquiring new clients. That's been our endeavor to be in probably every customer that we have. We like to intensify our, SOB and improve our ingress of all our product lines. So this exercise will never stop. Growth is something that we are always hungry about, and I have got no hesitation in saying the more we acquire new businesses, the more we move towards higher growth rates.
Right. Okay, Ramesh, great to have you on the show today. Thank you so much for taking the time out and joining in.
Thank you.
Okay, that's the word coming in from the management of Endurance Technologies. Stock holding up over 1% as we speak right now. But let's shift focus and let's try and understand what really is the projection for banks going forward, and especially if you were to classify as to what's happening between the private as well as the PSU banking space, let's try and assess their returns and which way NBFCs are going to move as compared to banks. We have with us Sameer Bhise, the banking research analyst at JM Financial Institutional, joining in on the show right now. Sameer, hi, morning. Great to have you today on ET Now. Sameer, if I just look at the incidents of the recent past, NBFCs were trying to overshadow banks up until last year. Do you think the trend has now reversed, or do you see it reversing?
Yeah, hi. Good morning. Thank you for having me on the show. So, in fact, if you see last year, the whole narrative was interest rates were on the rise. And to that extent, there was a natural inclination to play banks, which worked out beautifully towards the end of the last year. As a potential peak in rates has emerged in sight over the last year or so, last couple of quarters, which is where I think NBFC outperformance has begun. Are we still closer to anyway cutting rates or reduction rates? I don't think at all. But even a plateau of rates from a regulatory perspective has been good enough to see a bit of a valuation pop up for most NBFCs. We usually tend to prefer larger names across the board versus some of the smaller names. I think with respect to banks, I think the narrative is more about how net interest margins move in the near term. But over the medium to long term, I think two factors drive stock prices, which is growth and asset quality. I think as we look into FY25, growth will be the single most important parameter to look out. And that is what should drive stock returns in our view. Systemic credit growth is running at roughly 14.5% if we adjust for the HDFC Limited merger. Deposit growth has been a challenge, but if you see last quarter's data, deposit have sequentially outgrown credit on a sequential basis. So I think once this balances out, you should see a reasonable return from banks over a 12 to 15 months perspective. NBFCs, the class as such went up over the last couple of quarters. Incrementally, we would want people to move towards more quality names and have those who have delivered growth through cycles.
Sure. Sameer, private banks' profitability remains strong, but given the margin contraction, elevated cost ratios, normalization in credit costs, etc., you think earnings could be muted going forward and margins clearly have peaked out as of Q1?
I won't call it muted as such. If you see, if most frontline private sector banks, even if they manage to hold on to margins on a full year basis in FY24 versus FY23 or even a marginal compression, we think there are levers with respect to credit costs as well as OPEX to manage a reasonable mid-teens kind of earnings growth. In our view, that should not be a challenge. And as such, for most frontline names, valuations are not expensive. They are pretty reasonable in our view. So more of a slight outperformance to overall market returns is what one should expect from frontline banks. As I said, any growth levers from an incremental perspective should drive stock price than the outcome on margins.
On the one hand, you've got Fitch warning of a potential downgrade to several US banks, and on the other, it is highlighted that the risks are receding for Indian banks. So what exactly do you think is supporting this macro view for banks, in your opinion? And do you think that this will sustain, that Indian banks will remain, sort of isolated from that pain?
So I think if you see banking asset quality as a sector is at a decadal high levels. There is no leverage in the corporate system which has gotten built in. So as such, external risks are low. Small pockets of emerging concerns, I would say, are they alarming? I'm not sure yet. But people would want to see progress on how unsecured loans as a class behaves. Now, even there, I think most frontline private banks have lent to existing customers. So that should not see a meaningful challenge, but that is one area that one would watch out for. I don't think what is happening, especially with respect to US banks, could have a meaningful bearing as such from a fundamental perspective. while obviously near-term narratives could probably impinge on prices, but fundamentally, I think the sector remains in a quite solid shape.
Okay, now, given that the RBI has directed scheduled banks to maintain an ICRR of 10% in NDTL, what is your view on this? What is the impact that you see on margins? Which institutions do you think will really get impacted?
So I think that measure was more to kind of absorb some of the excess liquidity created, and since they had not raised frontline rates, and given the inflationary pressure still persist in the economy, it was their way of signaling that the withdrawal of accommodation stance still has to kind of percolate through. Which is why they did it. Does it actually impact margins in a meaningful manner? I don't think so, because they have also said that they will review this over a month or two as we enter the festive period and ensure that liquidity is reasonable. So I won't fret over on that too much from a margins perspective.
Sure. Samir, what about the gap between deposit and loan growth, which is higher for many banks, and they may need to accelerate the pace as well of deposit growth to fund the loan growth as well. How do you view this competition for deposits picking up?
Yeah, so I think that has been the overarching view that we've had, that banks which will deliver deposit growth should see outperformance versus those who don't. Thankfully, the system itself, if you see, on a March 23 basis, sequentially deposits have outgrown credit, which means that the incremental rates that have gone up on the deposit side are helping in driving deposit flows. And now, our view is that deposit rates will remain sticky, especially with one of the largest private sector bank now stepping up the momentum on deposit mobilization. So I think so the larger guys are better placed versus smaller guys from a deposits perspective, and which is why our positive stance is towards the larger versus the smaller ones. As far as the wedge between credit and deposit is concerned, I think as a system, we need to see greater deposit growth, and which will be a function of how deposit rates move. So hence our view that deposit rates will remain sticky for some time. Larger guys are well placed to navigate that.
Right. So could we see margin contraction in the near term for some more time?
So I think, yes, obviously you should see margins coming off from even 1Q levels. But as a whole, would that lead to meaningful earnings downgrades? I am not in that camp. I think frontline banks have levers to manage earnings even as some bit of margin compression comes through.
Okay, good to have you on board. Thanks very much for putting all of those details into perspective when it comes to the entire banking sector. Just a quick glance as to what the market is up to at the current juncture, and as we speak, it's continuing to remain pretty flat for the overall market. You've got a level of about 19,390 that's being held onto. The broader markets in comparison, though, significant outperformance today. A nice gain of about 0.5% for the mid caps, and the small caps too holding out in the green. And check in on the movers. Cochin Shipyard 11.5%, JM Financial soars in trade, SCI is up and about, something like a Grindwell Norton is a buzz, Hoodco, BSE as well as Schaeffler India. Those are the stocks that are on the move. But let's connect with the management of Angel One then to talk a little bit about the company's restructuring roadmap and how value unlocking is playing out. Prabhakar Tiwari is the Chief Growth Officer at Angel One, now joining in on the show. Thanks so much for taking time out. I'm just going to start off with those business updates because it was that restructuring that was announced to ensure increased and focused control over the business from each channel the clients had acquired through the authorized persons and directly via clients. So what is the timeline for this, and when will the restructuring be completed? What kind of value unlocking do you see?
See, this is a part of natural progression and growth for us. We have come a long way since we started on this journey. And it is important that we broad-base our offering and have the best business model supporting it. So we have already started that process. It may take its own course. However, you will see larger efficiencies and more upside in our business going forward.
There is a
Yeah.
there is a disruptive wave in your industry, whether it is on the brokerage front or also on the technology front. Engine One has done a great job in terms of customer acquisition and in terms of keeping the yields high. But looking at the fact that there is a big daddy, Geo Financial Services, which will be making an entry, do you see that the disruptive wave will only intensify?
Yeah, of course. I think we have a lot of respect for Geo, not just in the financial services they have entered, but also the way they have been able to make digital highways to tier 2, tier 3, tier 4 and beyond. And we believe with a player like that entering the market, it will create more category saliency and people's curiosity. And then, customers will make their choices. And we believe that in multiple categories, they will find us as the best choice.
There has been a mixed picture if I look at the new demat addition. Same time last year when markets started coming down, number of demat additions, they started coming down. But in last couple of months, given that market conditions are strong, the demat additions are coming back. How much of your business is dependent on new client addition? Is this something which could be a swing factor going forward?
Definitely, it's important that we keep adding to our customer base, and they have a significant impact on new revenue lines which come up. But more importantly, I think new customer base also help us cross-sell, upsell, with the kind of business we want to become. And in fact, the Super App launch we did in Q4 and stabilize in Q1, and recently we'll see our new campaign around Super App. The entire idea is that this new customer base, which comes to us, also chooses, a lot more newer products. I'm very happy to share with you that, we have a lot of new clients joining us as SIP first customers. In the month of July, we have close to 2 lakh unique MF SIP, which was 25% growth as compared to what we had in the month of June. So I would not just look at new customers as a new revenue line within brokerage. I would also look at them with their choice making within our app to the new products which we are supporting and the newer journeys which we have created.
The one thing I also want to talk about is, NSE recently barred Angel One from onboarding new authorized persons, right, for a period of 6 months. What's the legal course of action that you've taken now, and what are the timelines that you can share with us?
See, we are the largest player in terms of authorized personnel network, and we have been in this business for a very, very long time. Regulatory takes a lot of steps, to safeguard the interest of average investors, and we really respect it. We really believe that a lot of growth that we have seen and our sector has seen is because of the great work our regulatory has done. And the regulatory has, given us certain inputs, which we have taken into account. And we have started auditing 100% of our APs. And we are also looking to leverage more and better technology, to monitor this particular channel. As you know that we have restructured, to support B2B and affiliate business. So you can be rest assured that we are very, very serious about this channel. And being the largest player and the longest, kind of in the market player, it's in our responsibility to kind of bridge the gap and not just educate this channel on what regulatory aspects, but also tell regulatory that, how we can monitor this channel better and can keep the unwanted element out and yet serve the customer better. So that's what is going to be our focus.
Talk about how is it that you're looking at expanding your digital presence?
Sorry, come again. I didn't hear the question properly.
No, I just wanted to understand what is it that you're doing to expand your digital presence, the product launches that you may see in the current year and the next, and if your digital spends are only going to increase from here.
Yeah, of course. I think, we are a fintech broker and we have been expanding in a big way. Last month, we acquired close to 6 lakhs customer, and we are seeing amazing possibilities in this space. See, in terms of our spends, they will be higher by 6 to 10x in this financial year. You'd be seeing super app campaign for the first time. We have taken Hindi news channels. We've been spending a lot of money in YouTube, OTT, and also in business news channels like yours. And more importantly, I want to talk about our web product, which we call Spark Web. And to my mind, while we talk about super app, I think our Spark Web is what I will call super web. It's a completely new interface. It's not just about adding new feature, but it's about giving a terminal-like experience, broker terminal-like experience, to the traders. It has terminal-like keys. It has multi-charts layout. It has chart-based trading. It has a basket order. It is an integrated option chain. So, and we will put a lot of monies behind, to kind of get this feature out for the benefit of traders. So fundamentally, we are super confident about our super app and super web. And hence, this year, we will do a lot of spends on both traditional plus digital media. And we want to take our product story to the largest, customer base possible.
20% broadly, gross broking comes from the F&O segment. Some would say that it is a product which could be volatile, or it's a business stream which could be volatile, and it is completely dependent on market conditions. In a bull market, it will work. In a bear market, it may not work. How are you looking at insulating yourself from that?
See, first of all, I want to tell you that, F&O, we need to look at F&O from the point of view of it is an experience of the capital market. Okay, I mean, if it is there, it is serving some purpose. Okay, so I mean, let's not, kind of look at F&O in a way, which is not complementary, in my opinion. The second aspect is that if it is there, then are some people lured to use it in a manner which they don't fully understand? I think that's always a possibility. It's like, people going to gym for fitness for reasons which is just gossiping, networking, or just looking at other attractive people out there, right? That's a wrong reason to be in the gym, I mean, in a way. But fundamentally, sooner or later, these people may also start their, physical fitness journey. In a similar way, we fundamentally believe that as a responsible, brokerage platform, equity brokerage platform, we would nudge our customers. We will give them tools, which help them compete with the most sophisticated, players out there and learn from their mistakes. But fundamentally, we intend to, educate them about how can they become a long-term investor. Now, coming to the volatility part of it, in my opinion, you have seen our track record, for last 2 years, multiple quarters. I mean, people have, told us that we are a COVID success story and blah, blah, blah. But we have only grown stronger, and with our super app as a great product being in place, fundamentally, we are saying that we are just a transaction platform in terms of customer education, in terms of superior strategies on options, F&O. All of it will be provided on our platform. And it is up to our customers and clients on how they, intend to use it. So to my mind, we should look at number of orders, and we should look at the cross-sell, upsell opportunity, which is possible on our platform. And that will actually underline our growth story.
All right, let you go on that note. Appreciate, Prabhakar, you taking the time out. So that's the view coming in from Angel One, talking about how Jio's foray is only going to create category saliency, and how they are looking at, restructuring, creating larger efficiencies. That stock as well is up and about in trade today, 1787 on last count. Tell you what, we'll take a very short break. Be right back as we connect with our chartists for Chartbusters. Don't go anywhere.